been reacting. It's been quite a shaky start to the day that we had, swinging from positive to negative territory for the markets, and that's how we have been holding on very close to that 200-day moving average for both the Nifty as well as the Nifty Bank. What's lagging in trade has been, of course, the HDFC twins along with the IT pack. In fact, the IT index declining with an open equal to high. What's bucking the trend has been the PSU theme, both the Nifty PSE as well as the PSU Bank Index surging more than 1% each. As far as the broader markets are concerned, we are seeing some bit of outperformance come about as both the small and the mid-cap index have gained more than 0.5% each. And then you have the odd gainer from the metals as well as the energy pack. So essentially it is commodities as well as the PSU theme that has been gaining ground this Tuesday, in fact. But on that note, let me also bring in our market guest, Trideep Bhattacharya, who's the CIO-EQUITIES at Edelweiss AMC. Trideep, first and foremost, thanks for taking the time out and speaking with ET Now. Let me start off by asking you that, it's been a shaky start so far, in 2022. How do you expect the remainder of the calendar year to shape up?
Good afternoon, and thanks for having me on your show. Always enjoyed it. Actually, we've had this view right from the beginning of this year that by and large we expect this year to be a tale of two halves, where really the first 9 months would be quite volatile. And true to its nature, it is turning out to be that way. And the reason why we thought it would be volatile, because of really three. First of all, we expected this change in interest rate regime from declining interest rate to rising interest rate to cause a bit of flutter. I think where we are, that kind of issue is digested. The second issue is the inflation one, which is, although transient in nature, but has raised its ugly hood over the last 2 or 3 months. And I think we are at the moment, what we are seeing in the earnings season, or what we are likely to see going forward in the next month and a half, would be an increasing implication of the same, where we will see a two-phase kind of a result season where the commodity users will see the impact on its earnings, whereas commodity earners, the guys who benefit from the commodity rises, would actually see some positive rub-off on its earnings, so to speak. So it's a fairly two-phased in its nature in the way it comes about. And that's what you are seeing in the form of volatility in the market overall. But, if you ride through this on the other side towards the back half of this year and moving into the next 2 or 3 years, I think India versus what we have seen in the last 10 years, and also India in the global context, the investment thesis is looking fairly robust. So I think on the medium term, we kind of stay quite positive, quite constructive. While on the first 6-9 months of the year is where we are suggesting to investors to take a more graded look, to invest more in tranches rather than trying to be in a rush. So that's how I would answer your question, the near term, and put it in the context of the medium term.
Right. Trideep, of late what we have noticed is, some bit of shrinking in the valuation multiple as well. But it is now trying to stabilize near the long-term average, which is about 18 to 20 odd times. Nevertheless, it is still quoting at higher levels as well. But at this point in time, and given the current construct of the market, would you advocate fresh infusion of funds? And if yes, what's the strategy that you would advise?
I think it's a great spot. So I think just for the benefit of everyone, overall the decline in market multiples is more a function of the fact that overall, courtesy the rise in interest rate, the change in interest rate regime from declining interest rate to rising interest rate means that the cost of capital goes up. And hence, from that perspective, the same cash flows get valued a little lower. That's what we have seen over the last 3-4 months in terms of the impact on the valuation multiples. And that's why, as you were suggesting, that in some parts more than others, it is settling more in line with that of the long-term averages. We think that while that is more or less digested, the impact of the inflation onto the financials of India Inc., if I may call it that way, is yet to get fully factored in. And I think that will probably start getting factored in by the end of June quarter. So not the current quarter. So it will be partly in the current quarter, partly in the next quarter. So if I dovetail or if I kind of synchronize this into the investing style, I would recommend that investors from here on for the next 3-4 months invest in market in a more graded manner, in a more STP manner, in a more tranches rather than in lump sum. Whether they should or not, they certainly should, because over the medium term, a few things in India are looking good, which hasn't looked as good over the last 10 years. So invest you should, but invest in tranches rather than lump sum would be my mantra going into the market in the near term.
Right. Trideep, let's also, delve a little more deeper into the various sectors that are available. Now, how would you categorize various sectors into 3 buckets if I had to give you options of positive, negative, as well as neutral stance on sectors like BFSI, IT, auto, energy, FMCG, so on and so forth?
That answer in the prescriptive way, let me kind of talk about why I'm going to say so. So in my opinion, over the next 2 to 3 years, there are 3 things that are happening in the Indian economy which really stand out in the context of the last 10 years. First of all, I think over the next 2 to 3 years, there's a good chance that we see a private sector capex cycle, something that we haven't seen in the last 10 years. Secondly, I think there's a good chance that real estate sector, both direct and indirect, are actually bottoming out. Real estate turns out to be is generally a 7-year cycle, and hence would be positive not only for the equity markets but for the broader economy as well. And third, what we are observing is for the first time in the last 10-15 years, we have seen salary increases coming through in double digits. Now, this may mean problem for the corporates trying to maintain margins, but from the economic spending power standpoint, over the next 2 to 3 years is genuinely positive. So on the back of these 3 things, we think that domestic cyclicals is by and large the place to be from a medium-term perspective. So in terms of this, bringing that view in terms of sectors, domestic cyclicals in the form of industrials, in the form of lending financials, in the form of direct and indirect plays of real estate are areas that we are clearly positive on from a portfolio construction standpoint. And on the other side, the donors of capital, so to speak, are the ones that don't make the cut in terms of positivity, where we say neutral to negative would be basically pharma, IT services, and consumer staples and utilities. So broadly speaking, that would be my sectoral tilt, which is what we have at Edelweiss MF, most of the long-only portfolios, and we are fairly sanguine about them from the 2 to 3 year perspective as well.
Right. Trideep, last but one question. What's the current view on the broader markets that you have, the small and the mid-cap space? That has been at the heart of retail investment. So, what's the view on that one?
I think before the forward-looking view, a bit of a context is necessary. If you look at the year that we have come by, we've seen mid-cap and small caps gain at almost in the range of 45 to 55%. Which is quite substantial as opposed to what we are used to on an annual basis. So in that background, I would say that the valuation differential which existed between large, mid, and small over the last 12 to 18 months has by and large narrowed. And hence, going forward, the stock movement would be more stock specific, more company specific, and more earnings trigger specific rather than depending on which market cap category they fall into. So hence, if I were to take a 1-year view, I think I would be market cap agnostic. But from a medium-term standpoint, which is 3 to 5 year outlook point of view, given that my positive view on Indian economy is constructive, we would think that the mid caps and the small caps certainly deserve a place in investors' asset allocation, and they should be kind of taking exposure to the same. It is just that in the near term, they might suffer a little more volatility than we are used to or what we have seen over the last 12 to 18 months.
Right. And finally, what's the biggest risk that this market actually has at the moment, in your opinion?
Very simple. I think come Diwali, if we still see oil lingering around $120 plus, then I think all bets are off. There is academic evidence to prove that if oil sticks around $120 plus over more than 9 months, there's a reasonable chance of demand destruction, not just in India, but globally. And India would be kind of, not left out in such circumstances. And in those circumstances, I think there would be demand destruction, there would be more stagflationary situation, more recessionary conditions overall that we would be worried about. So that, in my opinion, is the biggest risk. Our resident view, our current view, as opposed to that, is that we think inflation is more supply-driven, more transient in nature, and by the time we get to the festival season this year, it should be kind of, by and large, resolved. So that's a balanced view with regards to the risk and where we stand right now.
All right, Trideep, thanks a lot. We'll let you go on that note. Pleasure speaking with you on ET Now. Moving on, let's also get in views from Rahul Chadda.